Hi guys, welcome back. Today we're going to discuss basic tax modeling for our financial forecast or for our financial models. If you haven't seen the previous videos, click on the link in the description box below and please consider subscribing because that will be super helpful. Right, so income tax. So in most countries, you generally have to pay a tax because that is how the government tends to fund itself. So that tax is usually based on your profits, and that's what we call income tax or current tax. So today we're going to discuss the things that we need to consider while forecasting our taxes. So the first thing we need to be cognizant of is the fact that there's a difference between our accounting profit and what our actual taxable profit is. Our accounting profit is the profit that we think we made, but our taxable profit is the profit that the government thinks we made and that we should pay tax on. So in our day-to-day business operations, we will record our revenues, we will record our expenses, and we'll come up with a profit number, and that's what we call our accounting profit. However, the tax jurisdiction or the tax regime might be different to what we are recording in our books. So maybe there's things that the tax authority will not allow or that they will only allow a certain percentage of. So it tends to happen that your actual profit that you've recorded, your accounting profit, will be different from your taxable profit. And hence, if you calculate tax based on those two numbers, they'll be different. So what you want to do is to calculate your taxes using your taxable profit following the rules of the tax regime rather than following the accounting rules. So let's see this in a practical example. So here we have a business, and in our business we made our profit before interest and tax of $120,000, and then we have finance cost of $40,000, which then makes our profit before tax to be $80,000. Now, assuming our tax rate is 30%, that means we have to pay a tax of $24,000, which leaves us with a profit after tax of $56,000. Now, let's assume that in the tax regime there is a rule that limits the amount of finance cost that we can actually deduct for tax purposes. So the tax authority might limit this in certain instances because of the different capital structures that people employ. But for our example here, let's assume that they will only allow 30% of our earnings to be deducted as interest. So if our earnings are $120,000, our maximum allowed interest would be $36,000, which is 30% of $120,000. Now, $36,000 is different from the actual $40,000 that we've incurred. So even if we've incurred finance cost of $40,000, the tax authority is only allowing $36,000, so that's the maximum we can deduct. So we go to, so how will our actual tax calculation be? So we'll have our earnings of $120,000, then the maximum allowed finance cost of $36,000 rather than $40,000, which makes our taxable profit to be $84,000, and hence we pay tax of $25,200 as opposed to $24,000. So you see, if you'd followed the accounting rules, you'd have recorded an expense, or you would have forecasted an expense of $24,000. But when you follow the actual tax rules, you record an expense of $25,200, which is a higher amount, and which helps you get a more accurate forecast and get a more accurate cash number. So the point here is that when you're forecasting your taxes, you want to use the rules in the tax regime or in the tax code as opposed to using accounting rules. And if you need guidance on this, you could always, consult a professional. But generally, you want to follow the rules in the tax code as opposed to accounting rules. The second thing that we need to think about is historical tax losses. Now, most businesses tend to make losses in the first few years of operations. And generally, in most countries, the tax code will allow you to use those losses to offset any future profits that you might have. So, for example, if we go to our sheet here, we have a business here that made a loss of $100,000 in the first year, and then a loss of $50,000 in the second year. In the third year, it turned a profit of $30,000. In the fourth year, it turned a profit of $150,000. So generally what happens in this instance is that these losses that we made in the first few years, we call them unutilized tax losses. We can carry them forward and use them to offset our future profits. So in the first year, we begin operation. So of course, we do not have any losses brought forward. That year, we made a loss of $100,000. So we have a tax loss carried forward of $100,000. In the next year, on top of this $100,000 from the prior year, we make another loss of 50,000. So now we've carried forward a loss of 150,000. Now in year 3, we make a profit of 30,000. 30,000. So that means which we offset against our tax losses of 150. So that means our tax losses carried forward is 120,000. And then in year 4, we make a profit of 150,000. So that means we utilize our entire balance of 120,000. So what does this mean practically for our tax expense? In the first 2 years, because we made losses, we basically pay no tax. In the 3rd year, we made a profit of 30,000. But remember, we had tax losses of 150,000. So we offset this entire 30,000 with our historical losses. So that means we also pay no tax in the 3rd year. Now, out of our losses of 150 in year 2, we've utilized 30 in year 3. So now we have 120 in year 4. So in year 4, when we make a profit of 150,000, we then utilize our losses of 120. So that means we only really have to pay tax on 30,000, and that is 9,000, assuming a rate of 30%. As opposed to, if this was not allowed, we would have to pay tax on the entirety of this 150,000, which would be 50,000, and we'd also have to pay tax on the entirety of this 30,000, which would be what? 9,000. So most tax regimes will allow you to carry forward your historical losses and offset them against your future profits. And this is especially important for startup companies that tend to make losses in the first few years of operations. However, most countries will also have a time limit. So it could be 5 years or it could be 10 years. So that means that after that period has lapsed, you can no longer use your historical losses. So if you don't make a profit in that period, then those losses are never recovered or are never utilized. So you need to check on the relevant tax code, or of course consult a professional. Then the 3rd thing that we need to think about is prepaid taxes. Now, sometimes you end up paying tax in advance and you are supposed to offset those taxes that you paid in advance with your tax expense later on. Now, the reason why it's important to consider this in your forecast is because of cash flow implications. If you have to pay a tax in advance, you should record that tax payment when it's made, as opposed to waiting until the end of your financial year or waiting until your tax filings are due to record that expense. You want to record the cash outflow when it occurs, as opposed to when you're recording your taxes. So an example of this is withholding tax. So in some jurisdiction, you'll find that when you record your revenue or when you bill a customer, the government requires that customer to withhold some of that money when they pay you, and they pay that money directly to the government. So for example, here we have a business that has revenue of 1 million and taxable profit of 300,000, and there is withholding tax which is charged on revenue at 5%. So what this means is that out of this revenue of 1 million, when we invoice our customers, they're going to withhold 5%. 5% of a million is 50,000. So what that means is that when our customers pay us, they will not pay us 1 million, they'll only pay us 950,000. That 50,000 goes straight to the government. So when you're doing our forecast, we need to account for the fact that we will only get 950, and the 50 will go to the government. So that helps us get our accurate cash number. So then what happens when we get to calculating our taxes? So our taxable profit was 300,000, and assuming a tax rate of 30%, we ideally should pay tax of 90,000. But then remember, we had already paid 50,000 because it was withheld at source by our customers and paid to the government. So that means we only really need to pay 40,000. So when it comes to the point of us calculating our tax expense, we will record an expense of 90, but we will only record a liability of 40 because we've paid 50. So this 50,000, when we pay it, we show a cash outflow in our forecast, and then on our balance sheet, we show it as an asset. It's a prepaid tax. It's a tax we've paid in advance, and it's receivable to us. Then later on, when we calculate our balance of tax and we show that our expense is 90, we then show that we need to pay an additional 40 to the government. So this 40,000 here will be shown as a liability on the balance sheet. So it's money that we owe to the government, and it will appear on our balance sheet as a current liability. Then the final thing that we need to think about is our tax rates. So what rate should you actually use to calculate your tax in your forecast? And ideally, you want to use the tax rate that has been enacted, the existing tax rate. In certain circumstances, if you're expecting an increase in the tax rate, for the purposes of your forecasting, it might be prudent to record that projected higher tax rate. Now, if you're projecting a decrease in the tax rate, again, it's probably more prudent to use the existing higher tax rate rather than forecasting a lower tax rate which might not materialize, because again, that is out of your control. So generally, you want to use the existing tax rate, or if you project a tax increase is coming, then use the higher tax rate. If you project a lower tax rate is coming, I'd say use the higher tax rate as opposed to the projected lower tax rate. Although you could always do both and come up with scenarios, a best case scenario and a worst case scenario. Right, so those are the major things that we need to consider. I've linked a free generic income tax calculator that you could incorporate into your financial forecast in the description below. So click on that link and you can access that for free. Please remember to subscribe. Please remember to like this video and share it with whoever you think might find it useful. Thank you so much for your time, and see you in the next one.